1998. Two Nobel Prize winners, the most brilliant traders on Wall Street. A mathematical formula that promised to eliminate risk forever. In 4 years, they turned $1 billion into $7 billion. The most powerful banks in the world were begging to lend them money. And then, in just 5 weeks, they lost everything. $4.6 billion. Gone. This is the story of long-term capital management, the hedge fund that almost destroyed the global financial system. To understand this story, you need to know a man named John Meriwether. In the 1980s, Meriwether was a legend at Salomon Brothers, one of the most aggressive banks on Wall Street. He ran the bond arbitrage desk, an operation so profitable it generated up to 100% of the bank's global earnings. His secret wasn't intuition, it was mathematics. He recruited PhDs in physics and economists from MIT. People who saw the markets as equations to be solved. In 1991, a scandal involving manipulation of treasury auctions rocked Salomon. The CEO fell. Warren Buffett had to step in temporarily to save the bank. And Meriwether, though not directly involved, saw his career there come to an end. But he didn't give up. He saw an opportunity. If he could make fortunes for a bank, why not make them for himself? In 1993, he began recruiting the team that would change Wall Street forever. John Meriwether didn't want to create just another hedge fund. He wanted to build something unprecedented. The first name he recruited was Myron Scholes, an economist who, alongside Fisher Black, had developed the Black-Scholes formula, the equation that made it possible to calculate the fair price of any financial option, the mathematical foundation of the entire modern derivatives market. The second was Robert Merton, a Harvard professor, one of the most brilliant economists of his generation. Together, Scholes and Merton were the architects of quantitative finance. But Meriwether went further. He brought in David Mullins Jr., vice chairman of the Federal Reserve, a man many saw as the next Alan Greenspan. Mullins left the Fed to join the fund. In February of 1994, long-term capital management opened its doors in Greenwich, Connecticut. A discreet building, no name on the facade. It launched with $1 billion, the largest hedge fund launch in history. Minimum investment, $10 million. Money locked up for 3 years. Who invested? Merrill Lynch, Union Bank of Switzerland, the Italian Central Bank, pension funds, universities, the biggest names on Wall Street. The strategy was called convergence arbitrage. Identify mispriced bonds. Buy the cheap ones. Sell the expensive ones. Wait for the prices to converge. The profits per trade were tiny, fractions of a percentage point. But there was a trick. Leverage. For every dollar of their own, LTCM controlled 25 in assets. The models guaranteed it was safe. At least, that's what the geniuses believed. The early results exceeded all expectations. In 1994, the fund delivered a 20% return, in a year when the S&P 500 rose just 1.3%. The following year, 43%, then 41%. Numbers that made the best money managers on Wall Street look like amateurs. Capital grew from $1 billion to $7 billion. But that was only the visible money. Thanks to leverage, LTCM controlled $125 billion in positions. And through derivatives and swaps, total exposure reached $1.25 trillion. About 5% of the entire global derivatives market, in the hands of a single fund in Connecticut. Banks lined up to lend, no questions asked, no collateral required. Because when you have future Nobel laureates and a former vice chairman of the Fed, no one asks questions. In 1997, the partners made a fatal decision. They returned $2.7 billion to investors. They wanted a bigger share of the profits for themselves. But they didn't reduce their positions. Leverage soared. That same year, Scholes and Merton were awarded the Nobel Prize in economics. Prestige reached its peak. The geniuses seemed invincible. but the markets were about to teach them a brutal lesson. Models capture normal patterns. When panic sets in, equations fail. 1998 was approaching, and with it, the storm. The first warning signs appeared in the spring of 1998. The Asian financial crisis, which had begun the year before, continued to spread. Nervous investors sought safety. Spreads between bonds began to widen, exactly the opposite of what LTCM's models predicted. In May, the fund lost 6.4%. In June, another 10%. $461 million vanished in 2 months. The partners didn't panic. Quite the opposite. They saw an opportunity. If spreads were widening, they would eventually have to converge. Just wait. The math was on their side. In July, Salomon Brothers announced it was shutting down its arbitrage desk. The same strategies LTCM used, the same positions. Suddenly, their biggest competitor was liquidating everything. Prices of LTCM's assets fell even further. And then came August 17th. Russia announced it would devalue the ruble and declared a moratorium on $13.5 billion in sovereign debt, a default that no one in the models had considered possible. The panic was instant, global, total. Investors around the world rushed to the safest assets, US Treasury bonds. Everything else was abandoned. The spreads that LTCM was betting would close exploded in the opposite direction. In 1 week, the fund lost $550 million. The next week, more. The models, built on just 5 years of historical data, had captured none of this. Meriwether himself later admitted that if he had lived through the Great Depression, he would have better understood what was happening. By August 21st, LTCM had lost $2.1 billion in that month alone, 44% of its capital, in a single week of August. The fund was bleeding, and there was no way to stop it. Meriwether sent a letter to investors revealing the losses and begging for new capital. He called George Soros, Warren Buffett, every name with deep pockets. No one wanted in. By September 22nd, LTCM's capital had fallen to $600 million, the same colossal positions, but now with leverage exceeding 100 to 1. The banks that had lent without asking questions began to grasp the size of the hole. If LTCM collapsed, it would have to liquidate $125 billion in positions all at once, a forced sale that would drag down the price of every asset. The creditor banks themselves would go under. The global financial system faced real systemic risk. That's when the phone rang at the Federal Reserve Bank of New York. On September 20th, Peter Fisher, Vice President of the New York Fed, visited LTCM's offices in Greenwich. What he found shocked him. No single bank knew the fund's total exposure. LTCM had done deals with 36 different counterparties. Each one saw only its own piece. No one understood the full monster. On September 22nd, the Fed called an emergency meeting. 13 of the world's largest banks in one room. The message was clear: if LTCM falls, you all fall. On the morning of September 23rd, a surprise emerged. Warren Buffett, through Goldman Sachs, offered to buy the fund for $250 million and inject $3.75 billion, a fraction of what it had been worth months earlier. Buffett gave Meriwether less than an hour to accept. The deadline passed. Meriwether couldn't get legal approval from his partners in time. Or perhaps he was hoping for a better deal. There was no better deal. That afternoon, 14 banks agreed to inject $3.6 billion into LTCM. In exchange, they took 90% of the fund. The partners who just a year earlier had returned money to investors because they were too rich, lost almost everything. David Mullins, the former Fed vice chairman who had left everything to join the geniuses, saw his career destroyed. He would never again be considered to lead the Federal Reserve. Myron Scholes and Robert Merton saw their theories publicly humiliated. Just 1 year after receiving the Nobel Prize, the chairman of UBS resigned after the bank lost $780 million on options tied to LTCM. The fund was liquidated in 2000. The banks got their money back, but the lessons went unlearned. 10 years after LTCM's collapse, in 2008, the world witnessed an even larger financial crisis. Lehman Brothers, Bear Stearns, AIG, names that crumbled for exactly the same reasons. Excessive leverage, mathematical models that failed, systemic risk that no one wanted to see. The lessons of long-term capital management were ignored. The Black-Scholes formula continued to be used. Derivatives multiplied, and Wall Street once again believed it had tamed risk. John Meriwether, the man at the center of it all, didn't disappear. In 1999, he launched another hedge fund, JWM Partners. He used similar strategies. It collapsed in 2009 during the financial crisis. He launched a third fund in 2010. History repeats itself. The geniuses keep believing that this time is different, that the models are better now, that they've learned from their mistakes. But the truth is simple. Markets are not equations. They are people. And people panic. 2 Nobel Prize winners. The best traders in the world. Mathematical models considered infallible. And yet, they lost everything in 5 weeks. If the most brilliant minds on Wall Street couldn't predict the chaos, who can?